China's manufacturing unit inflation hits 17-month low. Consumer prices speed up. Beijing. China's factory gate inflation eased to a 17-month low in July, defying worldwide fee pressures as slower home production weighed on raw cloth demand, despite the fact that patron charge profits hit a 2-year excessive as pork supplies tightened. The Producer Fee Index (PPI) rose 4.2% year-on-year, the National Bureau of Statistics (NBS) mentioned on Wednesday, after a 6.1% uptick in June and lacking analyst forecasts for a 4.8% increase. China's manufacturer charge boom has slowed from a 26-year high hit in October ultimate year, giving policymakers a few leeway to stimulate the flagging financial system while critical banks somewhere else scramble to hose down rampant inflation with aggressive hobby price hikes. While China's notably benign inflation has largely been because of weak domestic call for a moderation in worldwide charge pressures, which include falling oil expenses, also contributed to July's slowdown. Factory gate inflation will remain on a downward trajectory during the relaxation of the 12 months amid a similarly drop in commodity costs, easing deliver bottlenecks and a higher base for comparison, Zichen Huang, China economist at Capital Economics, said in a study's note. In a signal of the slowing momentum, PPI fell 1.3% month-on-month, its first monthly decline due to the fact that January, with the largest falls inside the price of metals and petrochemicals. In annual terms, coal mining and washing industry expenses rose 20.7%, slowing 10.7 percentage points from June, even as the oil and gasoline extraction enterprise jumped 43.9%, down 10.5 percentage factors, in step with a separate assertion from NBS. Input expenses slumped in July. China's official shopping managers index showed remaining weak, because of a decline in power and raw material fees and pointing to an eventual fall in manufacturer prices. The world's second biggest economic system has slowed appreciably and narrowly escaped a contraction inside the June region, weighed by means of strict COVID-19 controls, a distressed belongings market and careful client sentiment. The Client Rate Index (CPI) accelerated 2.7% from a year in advance, the fastest tempo considering July 2020 but missing forecasts for a 2.9% gain. The main motive force of customer expenses is meals inflation, which rose 6.3% year-on-year, dashing up from a 2.9% uptick in June. Driving the broader food surge had been pork expenditures, which shot up 20.2% year-on-year, reversing a 6.0% decline in June as production slowed. However, middle CPI, which excludes risky power and food costs and is a better gauge of underlying inflation, remained gentle, growing simply 0.8%, slower than the 1.0% upward thrust in June. Constrained doves. While the People's Bank of China (PBOC) is anticipated to maintain economic settings unfastened amid sluggish growth, there are limits on how much the financial institution can ease coverage due to worries approximately capital outflows, as the U.S. Federal Reserve raises hobby rates aggressively. The PBOC will consequently in all likelihood depend upon more focused easing to aid the recuperation, while client inflation examines China's 3% tolerance threshold. That approach, the prospect of a near-term across-the-board interest rate cut is low, given existing global inflationary pressures and interest price hikes in other predominant economies, stated Bruce Pang, a prime economist at Jones Lang LaSalle NYSE, JLL. In all, CPI inflation stays underneath the PBOC's target of around 3%, providing it the coverage area to stay accommodative, Aaron Shin, economist at HSBC, mentioned in a Be Aware. With endured uncertainty from COVID-19 clusters in addition to weak sentiment within the assets marketplace, there's nonetheless a want for the PBOC to remain accommodative.